Welcome to today's webinar, From ESG to Impact. My name is Rachel Pine, and I look after content for the PLSA's events and training. Today is our first webinar with our new education partner, UBP, which stands for Union Bank Privé, which I cannot say properly in French. We've all heard a lot about sustainable investing, climate investing, impact investment, ethical investment, ESG, SRI, CSR. It's a complete alphabet soup of terms which can mean different things in different contexts. However, the direction of travel on policy is clear, from last year's introduction of the need for scheme statements of investment principles to show how they take account of ESG factors, to coming regulations on schemes and funds needing to disclose how they are managing climate risk for savers. It's easy to see why agreement on the definitions is crucial. That's why we're especially delighted to present today's webinar with UBP, who are going to explain what the various terminologies mean and how to look at them within an investment scenario. After that, they will show us their innovative approach to impact investment, which really lets everyone from trustee boards to savers clearly understand how their investment is working and what is being created with it. This is absolutely unique, and I think you'll have a new way of thinking about impact investing after today's webinar. UBP is based in Switzerland with 100 billion pounds in assets under management. They were founded in 1969, which makes them young by Swiss standards, and this relative youth gives them the freedom to look at investments in a less traditional way. Joining us today from UBP are Rupert Welchman, who is the portfolio manager of the Impact Investment Platform, and his colleague Adrien Cambonie, who is an equity analyst on the platform. I'd like to start first with a question for all of you. So, I hope you'll all vote. Which is the most important element for you when considering responsible investing? Is it regulation, non-financial returns and measurement, financial returns, or you're not sure? And you can see that, financial returns are clearly the leader with this group, which is a very good thing and an excellent way to introduce Rupert Welchman.
Rachel, thank you very much for your introduction, and thanks for covering the topic, introducing the topic so well. From Adrien and myself, thank you very much for everybody for dialing in and listening to us today. So the topic, as Rachel mentioned, is ESG to impact. And our feeling as investment managers who are focused on impact and on the responsible investment side is that, as Rachel mentioned, it is this acronym soup that really feels very difficult for the outside world to get their hands on. It's something from personal experience that we know really is a world that could describe what they're doing much better than it does. So we're going to attempt to cast a little bit of clarity over certainly our approach to responsible investment. Here we go. Just checking my controls work. So now there are a number of different ways of attacking responsibility when it comes to investment returns. Now it's very interesting that so many of the poll actually still have financial returns firmly at the front of what they're doing. Of course, that is very, very important to the job of long-term savings and towards pensions as well. It's not something that we disagree with. I think there has been some suspicion with some of these types of responsible investment in the past that you have to sacrifice returns to fulfill those. And certainly, you know, we have the elements of SRI, ESG, CSR particularly, where we are mixing up these ideas of value and values, sacrifice, or in our view, actually maybe the acceleration of returns. And I'd hope maybe that we can open a window on the notion that actually by focusing on responsibility, particularly through impact, that it is possible actually to enhance the returns for scheme members. I was just going to make another point about this because I'm not very good at acronyms, and there are plenty on this page, but I was on a call this morning with someone who is from an organization called IMP, Impact Management Project, and he happened to mention 14 different acronyms in one breath, including B Corp, TCFD, GRI, SASB, PRI, CDP, etc. And the point is there are far too many of these organizations out there, and what we all need is clarity of understanding what it is that the investment managers are really doing. So just starting to peel back the onion a little bit here. When you're approaching responsible investment, our view is that you can do this obviously in two different ways. You can look at value driven. So the idea of a responsible investment or ESG integration into an investment process that really are intended purely for financial reasons. So the idea is that ESG factors actually mitigate any risks that you might discover or encounter rather as a long-term investor. It doesn't necessarily include exclusion on that side. On the right-hand side, you obviously have the values driven, so social responsible investment or corporate and social responsibility, ethical investing. Now, those elements do traditionally involve an element of the process being powered also by ethical or environmental considerations. And you obviously have an element of the exclusion or the divestment strategy included in here as well. So they're more targeted return, and that certainly in the values driven area is probably the real playing field when it comes to, is there this need to sacrifice returns? When we look at impact investing, there is a really distinct difference that we're making in terms of our approach. So, and I would hope that all impact investors are, I'm speaking really a common language of all impact investors here. So first of all, with ESG becomes really one of the tools that one uses as a traditional fund manager. It is almost the prerequisite of an institutional fund manager in our view, that you have those principles of environmental, social, and governance considerations in your head when you're making a decision. It doesn't actually drive your investment decision when you're an impact investor though. They are just parts of the building blocks. So an ESG investor would be concerned at the internal operations of a business, whereas the impact investor is looking at the outputs of a company, whether it's the products or the services. What good does that company do in terms of those products and services for the planet? And you need a framework that we'll go and describe to show how you make that judgment. But really your intention as an impact investor is to generate a measurable, beneficial, social or environmental impact alongside, and very much key to this, alongside your investment return. So here's a schematic which shows, excuse me, sorry. Just going to go back, there we go. Slightly smooth passage between the slides, occasionally trips us all up. So when you're looking at impact versus ESG, this slide is really all about the ESG elements. These are the kinds of considerations that we think that trustees, asset owners, consultants should be challenging us as investment managers about. What do you know about the board structure of a company? What do you know about that company's environmental footprint? How well is it measured, and how well are they reducing it? What kind of health and safety checks and balances do they have in place? But it's all to do with the operations of a company, and you're really looking at a sustainable company in the broadest sense of the word. So sustainability in terms of footprint or social policies is also sustainability of profits, because you don't get tripped up as a company. Now with impact, we're looking at the right-hand side of that product and service of a company. One final point on the next slide that I really wanted to mention between the difference between ESG and impact is that ESG companies, good ESG companies, can come from every sector. So actually, when you're looking at a portfolio and they say, well, we've got a very good ESG score, that is quite possible at the same time as being invested in something like Swedish Match which is obviously a tobacco company based in Sweden, Galp, which is an exploration and production company, or EasyJet, an airline. They're all very highly ranked, as you can see, those AAAs and AA rankings from the MSCI data provider. So they've got solid ESG credentials, which means they're quite well-run companies relative to the others, but that doesn't mean that they have a positive impact on the world. So that is the key difference that we're laboring here. Now, how is impact investing defined? Well, there are a number of organizations around this, and I would encourage you particularly to look at the GIN if you're interested in impact investing. The Global Impact Investment Network has become one of the real leaders and the voices within impact investing. They produce a half-yearly report on the size of the assets under management that are invested within impact in their own definitions. And they also are the leaders in terms of defining what impact investing is. And we have the definition here. You really do need a framework. And this is one thing that the GIN has been good to make sure they put their weight behind. That actually, in our case, that impact is defined as being revenues of a company or products and services of a company that are directed towards the UN SDGs, and the UN SDGs have below them something called the sub-goals as well. And all the companies that we think of as being impactful are aimed at one of those SDGs or one of those sub-goals. The other element that the GIN enshrines is the idea that actually we want to get capital working towards solving the problems that this planet faces, both societally and environmentally. But to get capital working, you need to ensure that you are combining both financial and non-financial returns. So there is a profit with purpose element that runs very deeply behind impact investing or underneath impact investing. Now, the point about impact investing that I've just mentioned in terms of these financial returns is quite a complex one. It is very interesting that actually when you look at the UN SDGs, there are some very large quantifiable numbers that have been set behind these 17 goals and the 169 sub-goals that sit underneath the SDGs. So it is estimated that $5 to $7 trillion is needed to be spent annually to fulfill the SDGs. That's a huge amount of money. In my experience in investment, one of the best ways to link outperformance with stock selection is to discover a following wind that the companies that you invest in can be lifted and grow in a superior fashion to the market more generally. Well, when you think about the SDGs and $5 to $7 trillion in that context, then we feel very confident that this is a way of creating an outperforming investment strategy. And therefore, when I said at the beginning that we didn't think you needed to sacrifice returns, actually this is turning it on its head and making the point for why that level of expenditure, if you can identify the companies that will be used to deploy that expenditure, then you will create good performance for your investors. I've just got one example of how this trend actually works on the ground. So on the right-hand side, a quote from one of the IEA saying, we're at the beginning of a huge redeployment of legacy revenue streams. And we're talking particularly about oil companies here. So huge legacy revenue streams that these companies generate just by being in that industry for such a long time. But it needs to be redeployed, not back into what they were doing, but into adaptation towards a cleaner, healthier alternative. And positive impact and its businesses really benefit as those large companies start to pivot away from what they have been doing throughout all their legacy to what they need to do in the future. And, you know, since we started producing this slide, what is fascinating to us is quite the level of change that we have seen within, say, the oil major companies out there. So Shell cutting their dividend, BP going enshrining in a carbon negative ambition by 2050, you're seeing some huge changes from some of these legacy companies. And on the left-hand side, this chart is probably now very out of date. It shows actually that CapEx, that cash flow being spent on renewable energies. And this is just purely by the European oil major industry. So by 2022, it is expected that $9 billion will be spent by the oil majors on renewable energy rather than on fossil energy. That is 10% of their capex. I suspect if we redid these numbers now, that number would be much higher, not least because those oil majors' own targets for cutting their own carbon footprints require nearer 30% of their capex to be spent on renewable energies just to offset. So if you are focusing an impact strategy on the types of companies that benefit from these revenue streams, what we call the fixers, then you can see how you've got this huge growth in terms of potential returns and potential profits coming towards you. Now, at this point, I'm just going to hand back to Rachel for another polling question.
Great, thanks, Rupert. So another question for everyone. Which group of the UN SDGs resonate most with you? The ones about environmental needs, social needs, they're both equal, or you're not sure. And as you can see, the vast majority feel they're both equal, but no one's chosen social needs as most important. So that's something interesting to look at. So back to you, Rupert.
Rachel, thank you very much. One of the interesting things we have recently experienced is on a panel that we were organizing last week, in which we covered education, so one of the social goals. And it was interesting that the particular organization that had done a poll on that occasion found that not one of their respondents put education up there as being one of the important SDGs. And we think that that's really actually very interesting observation at the moment, that actually the S of ESG, or the social elements of the SDGs themselves, have really risen in prominence during this lockdown period that we're all experiencing, and that actually that's going to maybe rebalance slightly the consideration and the focus from maybe some of those climate-orientated SDGs more towards social. I just wanted to make one other point about that oil example, because I was asked by Ian whether we were going to cover boycott, divestment, and sanctions as one of those acronyms of one ways of approaching investment. Well, our view is that when you're at the impact side, we do have a bit of a get out of jail free here, which is that we don't actually invest in the kinds of companies that have these issues as the majority of their business. So one of the elements that we really look at is the materiality of a company's revenues that are related to beneficial products or services. So if you are a company that is possibly in that area of boycott or sanction, then you're probably then you're not going to be at the focus of an impact investor. But at the ESG level, it is important to notice from the experience of these energy companies in the last 12 months that actually strong, disciplined shareholders can change the strategy of companies much more quickly by owning those shares rather than divesting them. So there are different ways of approaching certainly the values element of investment. But I do appreciate the pressure that some organizations have to encourage their asset managers to boycott or sanction or divest of certain dirty industries. Okay, so the next question we're looking at is measurement. So first of all, there are two types of measurement. First of all, you can look at the kinds of measurements that are related to footprint. So what we're looking at here is really the company's own tread on the planet. You know, how much are they looking to quantify their own CO2 footprint, the way that they treat their employees, their water usage, etc., etc. And then on the left side, we're actually looking at some of the impacts, so the measurement of impacts that the products and services of a company would have. And this left-hand area is becoming really fascinating. It's an area that's highly complex because it requires, if you are going to do it correctly, to be able to quantify the life cycle analysis of a company's products and services. And it also requires you to be able to assess, say, something like emissions avoided by the use of a product. So all of those elements mean that actually the idea of really quantifying impact is very complex indeed. But what our message would be is that this quantification process is moving along at some speed at the moment. And I think it's going to become easier and easier now that companies are more or less aware of the need to do this. One of the other questions we get is, surely it's just very simple. You just put your companies in your portfolio through one of the rating agencies' databases, and that will tell you how responsible your companies are. Well, that may be true, but we would just voice a note of caution here, which is that ratings seem to be positively correlated to two things. So higher ratings, the larger companies are in terms of market caps, and also to where they are geographically domiciled. So on the right-hand chart, you can see here that the average ESG rating for a company based in Europe is way higher than North America. Now that's explainable because Europe obviously has a green and responsible agenda that's far in advance of the US overall, but still it means that when you're comparing two companies against each other, then you need to be able to bear in mind that a small cap based in the US, for example, may well be at a disadvantage when scored on ESG rankings. And if you were to just look at a snapshot for a whole portfolio when you're looking at, say, a number of different funds, then really this kind of granularity on the ESG rankings for different companies is really important to judge. The other point to make is that we at no stage in our process of impact, of creating an impact portfolio, and I don't think any of our peers would do this, create a portfolio based on the ESG ranking. ESG, as I said, is a prerequisite of how we choose our companies, but we don't try to get a really, really high ESG ranked portfolio as one of our one of our powering factors. We let it all float to the top and actually engage with our companies if there are elements of ESG that need to be covered and rectified. Now, what you can do in measurement, first of all, is top down. So here's an example of what a lot of the impact funds people are producing, which is on the top side, emissions per ton. So we use USD's, emissions per ton versus $1 million revenues. And you can see we've just put the MSCI ACWI up here, MSCI Europe, and then our own positive impact fund. And again, it's not surprising that we are where we are because we don't have companies in general that are very high in terms of carbon emissions, like oil companies, for example. But you can certainly demand this level of granularity from all of your portfolio managers. And I would indeed encourage you, not just in impact investing, but throughout any type of fund that you're invested in, to ask for this kind of information, because it is now really quite freely available at the top level. This is also important from our perspective, which is the time series analysis of the similar kind of data. So we are capable of being able to quantify for you over time how the emissions and water withdrawal of our fund looks compared to indices. What we'd expect is that indices over time will improve, as you can see here, as companies get better at measurement and actually get better at their own usage, both in terms of electricity use, CO2, and also water. What is slightly more unique, although we do see a few of our peers doing this, is to try to build that bridge with the end investor, so the end scheme member, for example. And the end scheme member is less interested in conversations about the PE of a company or even the dividend yield, but they are very much interested in looking at their investments from the way that they lead their lives. And so we've spent a lot of time working with our companies to try to glean little observations about those companies and to try to be able to quantify what the benefits are behind the choice of our stocks. So for example, here, you can see that per million euros invested, the fund is associated with $7,000 worth of scholarships provided to students in Latin America, as per my education example, but at the same time with 1,100 tons of CO2 avoided, et cetera, et cetera. And we try to get a measurement, we do have a measurement for each one of the companies that we have in our portfolio along this kind of line. So in the absence of a really sort of detailed middle ground where we can judge every company along a similar kind of lines, you do have this situation where you have a top-down portfolio observation for a company, for a portfolio, in terms of water withdrawal and carbon dioxide emissions. And then you can show these bottom-up style observations as well. Now, what's key is that we're not satisfied with that. And I'm going to ask Adrien to start to explain how we at UBP are moving this conversation on in terms of measurement and engagement. Adrien, over to you.
Thank you very much, Rupert, and good afternoon to everyone. So some context around engagement. As Rupert just introduced, the current environment in terms of non-financial data is quite binary because of all the reporting inefficiencies that occur in the world of impact investing. And so the result, as Rupert explained, is a lack of standardization and comparability where we can either use the top-down data, which is usually easier to source and more homogeneous, or bottom-up indicators, which usually better translate a company's positive impact, but as Rupert explained, they are much harder to extract. And so this is why the notion of investor involvement has grown in importance in recent years. And the idea is that this activity of engagement enables us to better understand the strategies and the roadmaps of our companies, but also enable us to achieve that measurement of impact that we're looking for. And so as you can see here, in our view, an active engagement process has 4 pillars: a work of investigation on the companies, providing guidance to them, acquiring non-financial measurement, and developing collaborations for the future. So turning to the next slide, this was put in practice more than ever during 2019 through what we call the Impact Engagement Framework, which basically is our solution to a stronger and more standardized engagement practice. So basically, as Rupert explained, again, trying to really bridge the gap between these data sets in order to create a more standardized way of measuring impact. As you can see, in terms of structure, the framework includes 12 points of discussion, which cover both quantitative and qualitative aspects, and we run these with all of the companies. So you can see on this slide that it covers the company strategy, but also remuneration incentives for executives, environmental metrics, and also life cycle analysis. And so on this slide, you can see our findings. So our 6 themes from left to right, and the 12 points from top to bottom. And we presented the results in a color code format with 3 different levels. So this means that each company can either be unsatisfactory or orange, satisfactory yellow, or beyond expectations green for each item. And then we decided to aggregate those responses at theme level and to present this grid to you. Now, it's important to note that the objective was not to be punitive. So we didn't go into this project expecting only green throughout the grid, because in fact, having less than perfect reporting or disclosure is not seen as an offense in the context of the engagement framework. We just really want to be able to track the progress of our companies over time. And finally, you can imagine that having interacted with all the companies on a one-on-one basis, this heat map is built on many more data points, which allow us to extract information at fund level, but also theme level or company level. And so we can go to slide 21 now for some highlights. So firstly, at fund level, we discovered that 88% of the companies have either a pure sustainability strategy or one that incorporates the impact philosophy strongly. Also, 67% of the companies already have an emission reduction target. We also learned that 24% of companies have a chief sustainability officer, while 58% display an intention or an effort towards creating the role. And so I want to insist on this last point because it reflects the kind of new information and the new data points that the framework was allowed us to obtain, because this information is not available on traditional ESG or sustainability platforms. Next, we can have a look at company level highlights. We like to talk about Croda, with who we have engaged a lot over time. And the framework allowed us to understand all the work that they've been doing with their partners to develop the new 2030 goals. And for example, the most striking one for me that I like to mention is that every ton of emission emitted by the company will be offset by 4 tons avoided through use of their products, which I find is very ambitious, and we love to find such indicators. Secondly, we discovered Kingspan's very ambitious targets, net zero carbon manufacturing by 2030, and a 50% CO2 intensity reduction for their supply partners. Here again, this intention to collaborate with the supply chain is very important to us because it means that hopefully we are one step closer to being able to calculate scope 3 emissions, which, as you know, is a big challenge in the impact world. And then finally, there's a group of companies that we must mention. Usually they are at a very early stage in their sustainability journey, although they are extremely well positioned from a positive impact point of view. And so the conversations that we have with these companies is more around guidance and us explaining to them what impact investors look for and what we see in other companies. And this point, I think, also reflects how beneficial the framework and engagement is to both parties. So linking these components back to the first slide, we just mentioned the guidance and collaboration pillars. But this framework also provides us with a better understanding of our companies. So that is the investigation pillar. And it allows us to measure the efforts and disclosure of sustainability information, and we can track that over time. And so that corresponds to the measurement pillar. And obviously going forward, we run this framework with all the companies that we look at, and we are building a bigger database as time goes. And so that is it on engagement. So back to you, Rupert.
Adrien, thank you very much. In the interest of time, I'm going to move us on just to one other slide. So there are a couple of other elements that we wanted to share with you when we were considering what it is that we would expect investors, pension fund trustees, asset owners to look for in an impact strategy. And obviously a good connection with the United Nations Sustainable Development Goals is key, but also one element that we have established is called the UBP Impact Advisory Board. Now, the point of this external board is to judge the impact assessment that we are making on our companies. Because it is a novel way of looking at companies, the most important thing that we do is to try to assess impact. To that end, we didn't just ask other fund managers or other financiers to join our board. Instead, we went and asked Tony Juniper, who's the head of Natural England, Kanini Matoni, who is head of Tonic, a private impact investing network, and Jake Reynolds from the University of Cambridge Institute for Sustainability Leadership to come and help us and actually to positively critique the way that we are looking at impact companies. Bearing in mind that none of those people have any patience with the notion of secondary markets or the history of companies that have come before this impact phase. So they are very challenging and uncompromising on companies who need to make sure they continually up their game in terms of their products and services, as well as their ESG elements. Now, interestingly enough, the impact engagement framework that Adrien described so well just a moment ago actually found its genesis in our first board meeting with these individuals last November, because they asked questions of us that, what is it that, does every company have a sustainability report? Does every company have remuneration linked into those, to some element of ESG? And we think of the impact engagement framework as a living and breathing and evolving way of communicating in a standardized framework with our companies. The last board meeting that we had with these individuals, which was about a month ago, it was clear that they were dissatisfied with the amount of focus that we were giving both to biodiversity and also towards social elements, and particularly something like accessibility. So we had traditionally, as impact investors, felt that this was an area that was covered in the operations of a company, i.e. the ESG profile of a company. However, we are now working to bed in those other social and biodiversity elements as well, and really to bring in the framework to cover whatever aspects this board and we feel are relevant to companies. So as I say, it's an evolving framework, but we would expect that that all investors should have a similar style of openness to change, and the need to incorporate views from people in other walks of life, other skills like these three. Finally, I'm just going to mention collaboration. This is very much in the theme of just what I was talking about just there, which is that no fund manager is an island. No impact investment team can do it by themselves. We take collaboration very seriously, both with academic organizations like Cambridge, but also with our peers out there in the finance world, as you can see on this slide as well. And we also join boards where we feel that, or organizations where we feel that they really help to progress the cause of impact investing, particularly by embedding it into the companies that we might invest in. Now, with that, I was going to sum up and leave it there. I know we've covered a lot of ground, and maybe some of it quite fast, and we've surely left a few questions unanswered, but we're happy to answer any others that you might have. But thank you very much for your attention.
That's great. Thanks, Rupert. Thanks, Adrien. We have some questions, looking for some more if people have them, but I'm going to ask you the first one. It's from our friend Peter Flanagan, who chairs the DHL scheme. Peter wants to know, shouldn't all investors now be thinking about impact as well as risk and return? Past returns were secured without due consideration for the planet. Surely we can do better.
Well, I mean, I voted with my occupation on that front. I totally agree with what Peter's saying. There are blockers which are stopping us along the way. So for a long time, the suspicion or skepticism about investment return and how that collided with the fiduciary responsibility of trustees was a real issue. I think that is potentially changing, and I would cite or reference a Morningstar report which came out last week, which did a poll of over 4,000 funds and showed that over 1, 3, 5, and 10 years, sustainable funds in 7 different categories that they follow had all outperformed traditional funds. So I think that returns argument might have been laid to bed finally. But there's also this other element which I want to mention, which is I think we are in the very early stages and the foothills of this broader perspective. So the point I always make here is the UN SDGs actually only got published in January 2016. And I know that's 4 years ago, but it's actually a pretty brief amount of time. And also the best performing stock in Europe, European large caps in 2016 for the previous 20 years was a tobacco company. So perceptions take time to change. And I think that's why we're very excited that actually you're seeing this pivoting of capital expenditure towards good ends, but it is early stage. And yes, we do. I mean, ultimately, we think that if we're successful in the impact investment theme, then it won't become something that's unique and specialist to investors like ourselves, but will become mainstream. But that's the price to pay for actually sort of delivering the United Nations SDGs.
Excellent. I'm going to use my chair's prerogative and ask you a question next. You know, the pensions industry really struggles with engagement, getting savers to engage with their pension. Do you think, you know, something like this, which shows people, okay, this is what the money that's in your pension is achieving while it's accumulating for you, do you think this could help boost engagement?
Yes, I really do. I really do. And I think for the reason that we showed on the first slide, which is ESG and all its fellow acronyms are very unapproachable to the man on the street. So when you instead talk about the amount of ghost fishing nets that are pulled out of the ocean and recycled into yarn, or plastic bottles that are recycled, or scholarships that are donated in emerging countries, you're speaking a very different language to a much broader audience. And that's why I think that you can really start to bridge that gap between the finance world and the pension saver or the scheme member, and actually you do it in a really tangible fashion by us coming to them rather than them having to come to us. And the final point to make here is there are two really interesting initiatives that have come about in the last few months. The first one is Richard Curtis's Make My Money Matter. And the second one is the big exchange, which is being issued by, or is being promoted by the Big Issue, and particularly Nigel Kershaw there. Now, those two organizations are both much more socially relevant than your typical investment management house. So we think we really like the idea that these organizations and these individuals are much more approachable people than I would say investment managers are, but we can do our bit to supply and to explain what we do better. Really good to hear that. Ian Manning, who's a counselor at, I believe, Cambridgeshire County Council, he wanted to know, with all the examples, you've given a lot of environmental considerations. How about, are there any moral ones? For example, weapons sales or companies that are operating on illegally occupied land? Yeah, so, I mean, I just want to give a practical observation here. Maybe Adrien can help as well, because he does quite a lot of interacting on the way that companies are monitored. So actually, every company that is monitored in the listed markets has quite a lot of scrutiny about it in terms of the way it behaves. So these elements like occupying illegal land or creating weapons of mass destruction, or even right down to sort of unhealthy practices are actually relatively well covered by those agencies I referred to earlier. So when we have given maybe a bit more of a focus on environmental concerns, that is because we are following the UN SDGs and we are deliberately targeting areas that are hard to measure, whereas those kinds of transgressions are actually quite well measured already. So we would use our ESG providers to help us make sure that our companies are not transgressing in those areas. Really, really good. And have any councils adopted your framework yet? Not ours, but we do know that some local authorities have actually, and this is really quite recent, have started to incorporate impact investing within their suite of investments. And the other point I would mention is that we've never been busier in terms of requests for proposals for the kinds of investment strategies that we are actually operating. Really interesting. There's a few more technical questions here. So for all 17 of the SDGs, the Sustainable Development Goals, are they all investable in listed equities? It's a very interesting question. We don't think they are. So number 17 is called Collaboration with the Goals. We feel that by collaborating with our peers, with other organizations like Cambridge University, and by producing a set of impact funds that follow the SDGs, that we are fulfilling SDG 17 rather than with our investments. And the other element that I had to pass over for time was SDG 16, which is peace, justice, and strong institutions, where actually UBP's approach is there are no companies that generate revenues and profits from peace, justice, and strong institutions. But the goal is really important. Without peace, justice, and particularly justice and strong institutions, it would not be possible for the globe to deliver the other 15 SDGs. So we actually dedicate some of the revenues that we make from our annual management charge to invest in organizations that can fulfill peace, justice, and strong institutions on our behalf. So they are charitable organizations that we invest in.
Very good to hear. So I'm going to put your feet to the fire a little bit, because we talked a lot about the good side of impact, but really, what are the risks that investors should be aware of when doing sort of responsible or impact investing?
Yeah, well, I mean, one risk I'll give you as a fund, as a long-term fund manager, is that your typical impact strategy will have a higher valuation multiple on it. The rationale behind that is because today's fixers are solving today's but the future problems, which are just growing in size. So therefore, they are growth companies. We can expect growing revenues from them, but you tend to have a higher valuation multiple today for that. If you were to get what they call a big risk-off value rally, then we would expect that kind of investment process could underperform for a period of time. Our view is that that would be the typical kind of equity market cyclicality you have, where valuations get too extended, need to be reset, and that's usually an opportunity to invest again. And the reason we say that is because all our work, when we identify impact fixers, is about the long term. How long can we expect demand to be out there for their products and services? If you are sure of that, then you're on to some solid investment decisions in our view. The other element to be aware of, and why we've made a point in our presentation to flag and really be quite open and transparent about what we do, is that no doubt the more popular that impact investing gets, the more it will attract some organizations who maybe don't necessarily fulfill all the criteria that we try to fulfill. So we all look around at what other individual organizations are doing on impact and say, well, is that sensible? Is that something that's going to be helpful to the end investor? If it is, we should incorporate it as well. So we're always evolving. We expect other impact institutions to do the same sort of thing. So when you are assessing impact funds, my advice would be to hold all their feet to the fire, see what they disclose, see how they measure that impact, and see whether it makes sense to you as an investor, because those non-financial disclosures are as important as the financial disclosures that they may give.
Right. Really good to know. And do you feel, so this is all, I mean, you can't see this presentation and think, why don't I do this? Do you have to jeopardize financial returns to invest in impact?
Well, I don't think you do. That's why I'm running an impact fund, and why Adrien is helping me on it. But actually, we do have a pretty involved argument as to why that is the case. And I just refer back maybe to that slide on the oil majors. So an impact strategy looks to own the fixers, not the oil major that's making the change, but the fixers, the companies that allow that change to happen. That change, that process of change, whether it be about emerging markets, clean water, whether it be about education, whether it be about fuel cells or new forms of renewable energy, you go through the plethora of different things that need to happen in the world. They all have a fixer. Our job is to find that fixer. And if we're successful about that, then we will have a higher growth rate in terms of revenues and profits for the stocks that we own. And that generates outperformance over time. So we feel that this kind of strategy really marries this idea of investment returns with feeling good about what you're investing in very well.
Fantastic. And on that note, I would like to ask the audience another question, another poll here. So after what you've seen today, do you think an impact approach would help make investments and savings more accessible and engaging to the typical pension scheme member? Yes, no, maybe, or you need to learn a little more. Well, can see that yes and maybe. So I think we've managed to convince quite a few people. And it is a really nice thing to be able to go back and say, thank you both for your time today. That's all we really have time for. We've seen finally clear explanations of the various terms used within the responsible and impact investment spaces, and a really unique way for impact investment to work in specific support of the UN Sustainable Development Goals. Find the fixer, really, really interesting message that I don't think we've heard before. And for everybody listening today, thank you very much. Many thanks to Rupert and Adrien for joining us today, and to all of you who are watching, voting, and asking questions. We hope to see you again soon. Thanks very much, and bye for now.